Investing in the stock market can seem so complex and intimidating. So in this video, I want to give a very basic understanding, a tutorial on the stock market, what it is, to just remove all the complexity so you feel a lot more confident as a total beginner to the stock market and understand what it all is. I've worked in the stock market for around 20 years now, and I've seen all sorts of different types of stock investors, active, buy and hold and everything. So stick around for the next few minutes for this video. I'm going to go through the fundamentals of the stock market so you don't have to feel intimidated anymore and you can get started up in your investment journey. First, a little bit of a history lesson when it comes to the stock market. We're going all the way back to the 1600s. The Dutch East India Company was going on voyages around the world, trading in spices, metals, and all sorts of other things like silk and porcelain. These were very expensive trips and they needed some financing to help finance the expeditions that they were going on. So what did? They decided to allow the regular citizens to invest in a share part of the company or shared ownership of the company. They would invest their personal savings into the Dutch East India Company, and in return they would get a certificate saying they were part owner of the business or they owned shares in the business. And that's where it all started and where the name comes from. When you own a share in a business, you actually are a part owner, like these people were way back then. The Dutch East India Company would then use that money that they raised in the financing by issuing shares to regular citizens, and then they would go off on their expeditions. Of course, investors would do this, buy the shares in the Dutch East India Company in the expectation that they would get a share of the profits that they brought back. Of course, it was never guaranteed. These expeditions could come back with very little or just not have successful voyages for all sorts of reasons, and that was the risk that it was in buying shares back in those days. But that's how it all started. So shares would start trading just between people, between the company and individuals, regular citizens, coffee houses throughout Amsterdam, Antwerp, and that area, and eventually spread to London with the British East India Company, who did the same thing. So shares would trade in London in coffee houses throughout the 1600s and the 1700s, and stock exchanges then started to be formed, and stock trading, as we know now, was up and running. So now we know how shares got started and stocks got trading, all the way back in coffee houses in London in the 1700s. Just so you know, besides stocks and shares, they could also be known as equities as well. So if you hear that, it just refers to the same thing, which of course is equity in the business. You are a shareholder in the business. So nowadays, if a company has been a private company in that their shares are not yet listed on any sort of stock exchange and are not trading hands, this exists for many companies, and they're known as privately held companies, or private investors. It can be a lot more difficult for them to sell their shares because they have to go through a lengthier process. But nowadays, if a company decides it wants to list its shares on the stock market and raise financing, it will do so through an IPO, an initial public offering. So how does that work? So the company will seek out an investment bank for some advice, the likes of Goldman Sachs, Morgan Stanley, and others, for example. And that bank will do some due diligence, get an understanding of the business itself, and create a prospectus, which is just a very thick document which outlines everything there is to know really about the business itself. They'll then coordinate with potential investors, and at this stage, it's pretty much just institutional investors. Think pension plans and things like that, huge pots of money. And they'll actually go on a roadshow and visit these different companies, hand out the prospectuses, and talk about the business that's about to be listed. And these institutional investors can decide whether or not they want to invest in the business. Naturally, if they have confidence in the management, confidence in the business model, and confidence ultimately in the future of the business, that their earnings and their profits will grow, then they're likely to subscribe to shares and participate in the initial public offering. This is a great chance for early owners of the business to sell their shares to the institutional investors. It will also give a valuation of the company. Obviously, the company is putting their best foot forward in the prospectus, and sometimes they may be disappointed. Okay, there could be macro challenges like inflation we've seen in recent years, or the stock market may have a down year like we did in 2022 due to interest rate rises. And at that time, you'll see a lot less in terms of IPOs or initial public offerings. So companies tend to like to do it when they're going to get the best valuation for their business. Naturally, they want to get the best price and sell the shares at their highest amount to these institutional investors. Once the shares have been fully subscribed and the company's happy with the price that they can sell these shares to the institutional investors, then away we go. We'll then start trading on a stock exchange like the New York Stock Exchange, for example. And at that point, that's when the majority of retail investors, people like you and I, can get access to these shares and they start trading hands. So the IPO Listing the shares for the first time is considered the primary market, but once the shares start trading on the stock exchange, that is then the secondary market. And anyone with a brokerage account and money in the account can log in and start buying or selling shares as they wish. So now the shares are listed on a stock market or stock exchange, and that's really just a place that people go to buy and sell their shares, their shared ownership in a company. So what makes a stock price move during the day when the market is open? Well, ultimately, it kind of comes down to, like most things, supply and demand. But what would affect supply and demand? Well, the demand of a stock really comes down to their earnings. If the company is earning more money, then your share of that company is going to be worth more naturally, because the profits are there to be reinjected into the business to earn more money still, or even paid out to you as a shareholder just in the form of a dividend, just giving you money for being a shareholder in the company. But ultimately, the earnings per share, or the amount of net profit that a company has divided by the number of shares outstanding, is what ultimately will drive a stock price. Now, there's all sorts of other things that come to play. Interest rates, inflation, those are considered macro reasons that the stock price or the stock market in general might move. There's another variable, though, that's quite big and quite significant from time to time, and that is just human emotion. So sometimes the emotion, things like greed, can get so strong that a company with even maybe not the best of prospects will have its share price go up an awful lot just because people are getting on the back of it and can get all sorts of momentum. So there's all sorts of different moving factors. But ultimately, over time and over the long term, a company share price will do better if they're earning more and more money over that time period. Obviously, things like that and that will come into play as well, but their earnings per share is ultimately what drives stock prices. Now, how do you know about the earnings per share? Well, companies generally are required to produce their financial results every 3 months in the US. I've done a video recently on NVIDIA's earnings releases, so I'll put a link to the description in that and a few other videos you might find useful after watching this. But ultimately, companies will publish their earnings every 3 months, and that gives a chance for investors, people like you and I, to get an idea how well the company is doing and how well we think they're going to continue to do over the next few quarters and years. So it's very important to keep an eye on the earnings release if you're going to buy individual shares in a company. Shares and stock exchanges are also regulated. The Securities and Exchange Commission, for example, in the US, their job is to go in and make sure that the markets are operating with integrity and efficiently to protect investors from crime and things like insider information, pump and dump schemes, all sorts of nasty things that used to go on. So the Securities and Exchange Commission are there to make it fair for everybody and protect investors. A couple of things you want to know about the stock market itself and when you're buying shares in it. Ultimately, the stock market is not a get-rich-quick scheme, and this is where a lot of people go wrong. They think it is. They hear the stories like NVIDIA going up 3, 4, 5 times, whatever, Tesla like it did in 2020, and the emotion of greed takes over, and a lot of people will treat the stock market as a get-rich-quick scheme, and it certainly isn't. So if I were you and you're new to this, number one you want to be thinking about is long-term. Always think long-term when it comes to the stock market. Now, historically, the stock market has returned around 10% a year, just using the S&P 500 as an example. Whereas a bank account, you're probably looking at 4 to 5% historically, depending on, where interest rates are in the country that you're in. So why the extra, 5, 6% in the stock market? Well, because it's volatile. And what does that mean? The price can go up and down an awful lot for things like emotions, the macro economy, all sorts of reasons like I mentioned earlier. So therefore, if you have money in the stock market, you have to be prepared and understand that there's always the possibility that your shares can go down to zero, or if you're in the stock market through index funds and things, and I'll have a video in the description on that as well. But it can actually, a stock index could actually cut in half and go down 50%. So by putting money into the stock market, you need to realize that that risk is there and it's volatile. So you always want to make sure if it's money you might need in the next 5 years, it probably shouldn't be in the stock market. But that is why you get more of a return over the long term than you would do in a bank account. That extra 5, 6% is known as the equity risk premium, the additional money, the additional return that you would get over a bank account to take on that risk of the volatility and the stock market overall. But the stock market can be a great investment over the long term. You probably have a retirement account of some sort, a tax-free savings account, and most likely these are going to be invested in the stock market, ideally through index funds to reduce the risk and take advantage of diversification where you don't have too much money tied up in one company. I would always suggest you put the vast majority into index funds or exchange traded funds that track an index. But hey, if you want to buy some individual stocks, no problem at all. You got a lot of work to do in understanding the business and you want to do that, but maybe just limit it to 5 to 10% of your actual portfolio, so therefore you don't have to worry about so much risk. So the stock market can be a great wealth builder over the long term. Don't be intimidated. Don't listen to the media too much. They like to get on board. It's going to sell off from time to time. I've done a great video on that and market crashes. Again, link in the description. But that's the fundamentals of the stock market. It's got a great way to build your wealth over the long term. Some great history in there. And don't be afraid to get started up. So that's my video on the fundamentals of the stock market. I hope you enjoyed the video. If you did, why not subscribe to my channel? You'll get more good videos like this. Leave me a comment, share it with a friend, hit the like button if you like the video, and yeah, let me know in the comment section what you thought of this video or anything else that you would like me to cover on. I've got 20 years experience in the markets of all sorts, not just stocks, options, ETFs, Forex, commodities, the whole bit, futures markets, everything. So subscribe to my channel, get more great videos like this, and I wish you the absolute best in your investment journey.